I'm recording now.
Great. And good afternoon, everybody. My name is Michael Filighera, and I am excited to participate in another wonderful Synergy Tech Wizards day-long series of webinars. Today, my presentation is going to be on the analytical tools that I use for day trading. And the first one that you should be able to see my screen is an account that I put on and follow, and this happens to be in the NASDAQ 100 index. Before I actually get into that, because I'm sure you're just looking at kind of like with a lot of squiggles and lines and funny little numbers running up and down this chart, I want to give a little bit of a history of the Elliott Way Principle. And the reason that I'm doing this is because it's been around for over 80 years. And in that time, particularly in the time within the last 20 years that we've seen everything go electronic, there have been a lot of new interpretations of the Elliott Way Principle. There's been a lot of additions to the Elliott Way Principle, and it kind of starts to stray outside of what was originally presented as the wave principle by R.N. Elliott. And so I want to kind of give a little bit of background of him, what happened, and what the original response from the investment communities was. So this article that I'm just going to read a small portion of was published in 1939 after R.N. Elliott had submitted his 12 articles, which were entitled The Wave Principle. During the past 7 or 8 years, publishing of financial magazines and organizations in the investment advisory field have been virtually flooded with systems for which their proponents have claimed great accuracy in forecasting stock market movements. Some of them appeared to work for a while. It was immediately obvious the others had no value whatever. All have been looked upon by the financial world with great skepticism. But after investigation of Mr. R.N. Elliott's wave principle, the financial world became convinced that a series of articles on this subject would be interesting and instructive to its readers. To the individual reader is left the determination of the value of the wave principle as a working tool in market forecasting. But it is believed that it should prove at least one, a useful check upon conclusions based on economic considerations. And what I find very interesting about this particular little blurb of an article is how they were talking about in 1939 that the market is virtually being flooded with systems for which their proponents have claimed great accuracy in forecasting stock market movements. This is 1939. And here we are in 2021. And if they thought they were being flooded then, man, they've not been around. Of course, because now they're too old. But can you imagine now writing the same article? It is very fitting. There are many, many different strategies, different plans, different methodologies that get flooded into the market and all claiming that whoever uses it should be able to grab the golden ring and run off into paradise. What I find also interesting is that we've kind of gotten into an area in trading where you basically can kind of come in and give it your best shot, but if you're going to be serious and you do want to be a professional trader, no matter if that's a swing trader, a position trader, an options trader, a forex trader, et cetera, it's going to require education. It's going to require a lot of patience. It's going to require learning about the market that you're choosing to trade. And there are many factors that need to go into this. Now, when I first entered the market, I was back in 1979, it was extremely different than it is now. I was a member of the Pacific Exchange options trading floor, and it was a closed club, so to speak, because you needed a membership to the floor, and you needed to be able to then make markets. And when the Pacific Coast first opened their options floor, they went up into Reno and to Las Vegas to get gamblers to come on in and make the markets. And it was actually a very successful idea, and it worked out perfectly because they did get quite a few market makers who did come in with a large sum of money and gambling aspect of making a market and buying and selling calls and puts. I always found that a little bit humorous, but nonetheless, I went into the market. And again, when I said it was kind of like a closed club, because you needed to have a membership to get on the floor. And you also, all news that came in about the stocks or the options that we were trading exclusively on the Pacific, we got that news first. That's what I kind of mean about a closed club. So it's like if there was a particular financial report that was going to come out, we saw it before the greater public saw it. That, of course, is all changed right now, and we all get it at the same time if we're lucky. Otherwise, we're working with somebody that's already paying hundreds of thousands of dollars to get it maybe 15 to 20 seconds prior to everybody else. Nonetheless, I personally, after the 1987 stock market collapse, began to study technical analysis. I had felt very strongly that there were warning signs that I missed totally, and knew that if there was a little bit stronger understanding of the different components of a market and what was going on, that I would have received a sign that something was up and to not get broadsided by what happened on October the 19th in 1987. So in 1988, I attended my first Elliott Way Principle seminar, and that was given by Robert Prechter, who actually worked with A.J. Frost, who worked with R.N. Elliott in developing the wave principle. And also Dan Ascani, who also taught at that particular time and taught me, he and I became very good friends and ended up trading together and writing together and doing quite a few things together. But at that time, I became immediately hooked on this whole principle and how we constructed it. And back then, of course, we didn't have the computers that we have now. So you had to have a pencil, a ruler, several pages of large graph paper. And that's how I began to construct my hourly chart. I started by notating the price of the index that I wanted to track every hour. So I had one entry on a graph once an hour. And there were many nights that I literally laid out my big picture, right? I wanted to look at what my big picture of this market was across the floor of my apartment in Amsterdam over in the Netherlands, because I actually was living there at the time. And still have those in a box in my storage room here in San Francisco. And every once in a while, I'll go in and look them on, and now they're very discolored and a little bit faded, but boy, do they bring back memories. So to dive right in here, the Elliott Way Principle is a system of derived rules and guidelines first used to interpret the major stock market averages. As applied and used by R.N. Elliott, it offers a precise roadmap of the underlying which is being analyzed. Now, there are 4 rules and 9 guidelines that have stood well against the test of time. So the basic things I can tell you: don't break the rules and apply the guidelines. Anything different is effectively not the Elliott Way Principle, and it becomes different, like the John Doe Principle or Mark's Principle or John's Principle. So the wave principle is a valuable tool. It's very unique in nature due to its general characteristics and its strong accuracy when used correctly. The wave principle measures with striking precision market psychology and behavior. Now, this back in the 80s, the 90s, and the beginning of the 2000s was a major advantage for me, because markets did react psychologically, emotionally. That's because we were human beings and we were the ones making the markets. We were the ones doing the trading. We were the ones that actually could create an upward crash as well as create a downward crash, because what was going on? Fear, emotions. And with the advent of computerized trading and algorithms, a lot of that has been removed. The market psychology and the behaviors are still there, but you need to kind of update, or I needed to kind of update what was going on and why. Because what I could base a lot of my decisions on, the psychology previously, got expanded, got truncated, or just evaporated altogether. So the broader concept of the Elliott Way Principle is as follows. Within the context of the direction of the trend, whether it's a bull or a bear market, will develop and build upon or within sequences of 5 waves, 3 in the direction of the larger trend and 2 in a counter trend direction. So in other words, if we're talking about 5 waves, waves 1, 3, and 5 are termed impulse waves. Waves 2 and 4 are corrective waves. Wave 2 corrects wave 1, wave 4 corrects wave 3, and the entire sequence 1, 2, 3, 4, 5 is then corrected by the sequence A, B, C. So therefore, a complete sequence cycle consists of 8 waves. So the magnitude of the duration and the size was also discernible to Elliott, and he precisely categorized them into 9 different ranges: grand supercycle, supercycle, cycle, primary, intermediate, minor, minute, minuet, subminuet. So correctly employing the principle gives the analyst valuable input with regards to where the market is within the larger trend, or which is larger trend that's in force at that time, and that which in turn will provide a clear roadmap complete with directions. Now, Elliott wrote Nature's Law, which made specific references to the Fibonacci sequence of numbers as being the mathematical basis for the wave principle. So let me just give you a little history of the Fibonacci, and then I'm going to turn to that chart, which you can see, and we're going to start delving into that. The Fibonacci number sequences gained popularity since Leonardo of Pisa gave credence to logical sequences. And again, if you know anything about me, I love logic. I like things to move logically and to have purpose. So Fibonacci was born in 1175 in Pisa, Italy, and was known by several different names. But what he did was he started to write a series, and now it got the name of the Fibonacci series. And the number sequence presented is 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, and so on, all the way to infinity. You could just keep going. Now, the way with that number sequence is presented, starting at 0, you take the next number, 1, you add them. So 0 plus 1 is 1, 1 plus 1 is 2, 2 plus 3 is 5, 5 plus 3 is 8, and then you can see how that is now going to build and continue out into infinity. So the ratio of any 2 consecutive numbers in the sequence is approximately 1.618, or its inverse, 0.618, and that's after the first 4 numbers. So you'll be able to see now we've got a relationship between this number sequence. Now, pi is the ratio of any number to the next higher and is approximately 0.618 to 1. And to the next lower number, approximately 1.618 to 1. So between the alternate numbers in the sequence, the ratio is 2.618, or its inverse, 0.382. So now we're building the relationship, we're building the sequence, and we're building how we now are going to start to apply this into the market. So the demonstrations of how nature is built upon and human beings have instinctively used the Fibonacci sequence, also known as the golden rectangle, the golden spiral, the golden ratio. It's all very well documented, and you can go and you can read up on that and really delve into it, and it's very interesting. The golden spiral, or the logarithmic spiral, has no boundaries and is a constant shape. The center is never met and the outward reach is unlimited. Thus, the core of a logarithmic spiral on a microscopic level has the same look as a spiraling galaxy. And that's all very, very interesting if you think about it. And now, and I kind of keep that in mind, that how nature is built and that the center is never met and the outward reach is unlimited. So the core of a logarithmic spiral on a microscopic level has the same look as a spiraling galaxy, which we know is billions of miles. So the concept of limitless growth is clearly represented by the golden spiral and was so noted and used by the Elliott Way Principle, which is built upon the law of the logarithmic spiral, which is also known as nature's law. And it makes total sense if we believe that the markets, which are humanly traded, our brains are set up under nature's law. Our physical construction is actually Fibonacci relationships all over our bodies. And that's a whole nother subject, and you can go in and you can break all that down, and it's fascinating. So this adds, and people say, well, why would Fibonacci work? It's because it's instinctive. It's instinctive in nature. It's instinctive in our brains because this is how we are constructed. And so we begin, I believe, to think that way. And when you get into a large crowd and we're all doing the same thing, therefore, many things happen because it reaches a peak. It turns because it's reached a number, and then it starts to go. So Elliott also noted the most common relationships between the various waves was measurable. It is these relationships upon which Fibonacci analysis is built. And I will talk about that as we now go over to this chart. So how do I basically use this? Because those of you that have known me and you know what I'm doing now, I have switched from being a position trader, and I was a trader of options and the underlines and the different indexes, and I traded anything I could get my grubby little hands on because I love trading. And I decided when things went electronic that a lot of that edge that you had on the floor disappeared. And that I felt a little bit like a fish out of water, not being able to get the news or the input either at the same time everybody else did or prior to everybody else did. And so I left the floor as I noticed that most traders were beginning to go off to offices and reform how they were going to trade. So I came home and I set up a home office, and I decided that's what I would do. I would start to trade from home, continuing to use my Elliott, but now it was all computer based. And when the markets really began to get volatile, and say, for example, from in the NASDAQ right here in 2000 to 2002, that was quite the little drop, I want to tell you. And it was fascinating to witness, fascinating to trade, and also the first real devastating bubble bursting. And living in San Francisco, which again, at that time, which is where most of these tech companies were, just south of the city in Silicon Valley, but many of them were right here in the city, we felt that bubble bursting pretty tightly, pretty severely. So when this got done and it came down, I figured that's a bottom. And then we started to rally again. And I realized that I had to put a degree as to where I thought, what degree these larger moves were taking, because what we were beginning was a cycle level, and that would have been in October of 2002. We began a cycle level advance or 5-wave advance off of that low. And what that does tell us, or told me, again, at the time, you have to let a lot of things roll out before you can determine, oh, this is going to be a much, much bigger move. because I'll tell you, when we got to this level here, everyone's like, okay, that's it, and boom, we're going to watch, because here, this little drop is not as severe as that drop, but that's the financial collapse of 2008, 2009. And those of you that, quite honestly, I'm sure quite a few of us were alive during that time or in the markets during that time. And it was pretty scary. It was very scary because we watched Lehman Brothers go bust. We watched Bear Stearns close its doors. We watched other brokerage firms teeter on the brink of disaster, such as Merrill Lynch. Merrill Lynch was going down, and they were going down fast and hard. Then we started to watch them go after particular companies. We saw them devastate Morgan Stanley. We saw them, all of the large brokers. They just went after them, hammered them, short sold them. Then we watched them just choose different areas of the economy, particularly the cars, the automotive. And one that I remember very, very particularly, and it would have come on right down in there, was they were just hammering and hammering and hammering Ford Motor Company. And I remember thinking to myself, as an Elliottian, this has got to be a bottom. But they were willing to sell this thing down below $2. This is a major automobile manufacturer who has plants all over the world. And they have numerous plants in Michigan. They have them in Ohio. They have them here in California. And I thought, you know, bare bones, if they had to shut down and that company was going to go out of business, that company has to be worth more than $1.50 a share. Simply because if they had to liquidate everything, that would, I would presume, collect more than the $1.50 a share. And I ended up buying Ford at $1.50 a share. And that ended up being the bottom at that time. Of course, being the trader that I am, as soon as it traded $10, I was out. I thought, well, you know, that's a great deal. But it was just a very bizarre time. And now that we can look at it in this larger context, when we were going through this, it felt like it was the end, that we were going to move into a depression, that there was not going to be an end to this. It was just going to be the collapse of Wall Street. Well, we got a new administration in Washington, D.C., and they came out with the $800 million rescue package, which rescued the automotive industry, which rescued the banks, because all of these smaller banks were just dropping like flies, because they were having, there was runs on these banks, and so they couldn't meet their obligations and they couldn't stay open, so they were being absorbed. We saw Bank of America step in and buy Merrill Lynch. We saw JP Morgan turn around and buy Chase Bank. We saw Citigroup pick up banks, et cetera, et cetera. Wells Fargo picked up, I believe, a couple of things, but a lot of the big boys, they were picking up banks, but it took a long time to really start the recovery. But nonetheless, so after that came to a conclusion, this initially, I remember counting, this was A, that was B, and now we're going down in the C wave. But the patterns themselves failed to really follow through and produce the type of moves that we needed. In other words, if you're not, like, remember, an impulse move, whether it's bullish or bearish, is going to roll out in 5 waves. This thing rolled out and came down in 3. So I kept waiting for this move to come down and take out that low. It didn't. And as soon as it didn't, it left this as a 3. Because what it needed to do was, if you want to say 1, 2, 3, 4, that 5 had to come down to complete the 5, but it didn't. So it left it as an ABC, and that was off to the races. So Elliott Wave helps you determine where you are, what's going on, what are the limitations, and what can the expectations be, simply by correctly and accurately applying the principle. which is why I was saying before, there have been a lot of additions. There have been a lot of people that yeah, 3 ways down, oh yeah, okay, or 3 ways up, then we get, they don't interpret it properly, and they don't actually understand how to count the internal waves. Now again, this is a monthly chart, and it's 21 years, or going to be 21 years, so it has 20 years for sure of data before us. And I had to reframe myself, and I had to realize this is turning into a cycle level 5-wave advance. And that's what I had to count. Now, when you begin these things, wave 1 is the rally, wave 2 is the correction, and wave 3 is usually and most often the longest and the strongest portion of the rally or decline, depending on the trend, the direction of the trend. In this case, it's up. So our upside trend was going to be long. Now, you remember when I was beginning, I was talking about that the Elliott Way Principle is usable from a tick chart to the monthly chart. And the reason is because R.N. Elliott made sure that we understood that each of these moves are building blocks at add and go up. So I can come all the way down to a, let me do this, to a 5-minute chart, and that's just showing me a week. And look at that movement. They're all Elliott waves, and they work out very, very cleanly. So that 5-minute then builds up to the 15. Same type of look, but we got a little bit cleaner, a little bit more definition. Then you can go to the 30. Now we've got a little bit more information. Now we're going up to, we can go up to the hourly. And as we continue to build, you'll see, oh, we're adding more days, and therefore there's more movement, but it's all the same. The direction of the trend remains up. So what we're seeing is 5-wave rallies, 3-wave declines, 5-wave rally, 3-wave decline in the process of a 5-wave rally. I'll get into that in a second. And as I continue to go up, we continue to count. Now you can see we're basically at an area. Let me go back out to that monthly chart. When I got to the daily, that's where it was ending, and this is what it was starting with. Now, interesting. I wish I could show you 1987 because it's a little tiny blip that looks like this on the long-term charts. It's for those of us that were there, that we lived through it, that it was shocking. It was like, we were like, oh my God, it's the end of the world. And then historically, you can go back and look and it's like, oh my God, that's it. That's the little blip, that blip on the chart. So everything in perspective to what's going on. So here we are. I'm counting a cycle level, which is going to complete a super cycle level 5. So in that super cycle level 5 are going to be 5 waves of cycle degree. Right now, I'm getting ready to put the finishing touches on cycle wave 3, which is going to be up here. It hasn't finished yet. I'm waiting for it to finish. We keep thinking it's going to finish, and I'll explain why in a little bit as to why it's not finishing. So now I'm starting my count. Cycle 1, cycle 2 are in place. Now we're taking a look at cycle 3, which has extended twice within the, and these are primary waves, right? Primaries. And then these are the minute, and these are the sub minuet within there. So we start with, we get our first 5 up, 1, 2, 3, 4, 5, and that is primary wave 1. We get a quick decline, primary wave 2. Now we're beginning our primary third wave. And we got 1, 2, 3, 4, and then it subdivides again. So the dividing first, and then within the fifth wave of primary 3, it subdivides again. 1, 2, 3, 4, 5 of 5 of 3. This is the COVID slide that we did last March. Now, again, if you were there, it really felt like, oh my God, we're going out. We're going to hit the bricks. We're in trouble. Remind you that this index was at 97.63. It dropped 3,000 points, 38%. It dropped 38% in a heartbeat in 3 weeks. That was fast. It was furious. The money was wild. It was flying all over the place. You had winning days. You had some really nasty losing days if you were not on the right side of a trade. But nonetheless, it ended and blasted. And everyone started to think COVID is over. The perception that COVID was over was there. But then we started to realize much other things. Now, initially, I was thinking that could have been the end of cycle 3, and then we should have a larger cycle wave 4. But the minute it stopped and it janked up, I thought still could happen. And now I'm going to go down to a weekly, which will give us more information. It started to happen. I thought, okay, wave A, because remember, in a corrective wave, the way we're going to correct a 5-wave advance is you're going to have an ABC decline, A being a decline, B being the intervening rally, and C being the continuing decline. This is a weekly chart. We'd have to go in and see better. The internals are pretty clear that it was an ABC, but look what happened. So if it was truly just an ABC, I would expect that we had the possibility to rally between 40 and 68%. Once you start moving above that 68% off that low, you're likely not going to be, it's no longer going to be corrective. And then it started to get steep. We had problems, we had days, and these are down weeks. So we still had many of those going on. Nonetheless, this got put in as a 4 when this broke that high. I held it pretty much until I could get up to where it's like, this just isn't, it's not corrective anymore. It's not a B wave. We can have an irregular B wave, and there's only one form of impulse wave. Whether it's up or down, it's still just an impulse wave, consists of 5 waves. Corrective patterns in any of these markets, corrective patterns can come in a variation of 13 different types of patterns. So corrections are a bear, sometimes to trade and sometimes to track, because you're thinking, okay, we should be doing this, and then it turns and does something totally different. And that just keeps a good Elliott Wave analyst on their toes. Now, having said that, we get the 4, and now we start to rally again. So at some point I thought, you know what? I got to start counting this as a 5-wave advance. So I did. And here was 1, and that was 2. So it happened very quick again on a, let me go down 1. Because if I take it down to a daily, it should clean it up. Again, here's our end, and here we are starting up. And you see, look at those 3 waves, rally, 3 waves, rally, 3 waves, begin to rally. So I had to start to count all of this out. And as far as I could tell, I got the first wave up, an ABC back down, and I called that 1 and 2. Then I need to start counting a 3rd wave. And I did, and it subdivides, and you can count it all out. However many times you want, it'll all go all the way up to here. Now, initially, this is 9,734. And boy, at the time we were like, whoa, this is really high. You know, we're up in this into the rafters. I remember thinking that. Well, when I got up to 12,000, I thought we're really in the rafters and we're overextended. So I was really looking for some major breakdowns here. Each time they would start, they were fabulous to trade, great to trade from the short side, great to trade from the long side, actually, if you're trading it on the small scales that we do on an intraday basis. But it kept only doing 3 waves. Then it would rally. Then it did another 3 waves. Then it starts to rally. So they subdivide out, and it was like crazy. It got to be a little bit crazy. I thought, okay, we're doing a weird 5th wave up, and it kind of struggled and struggled, but then it just started to go. But you'll see each time 3 down, 3 down, 3 down, rally, 3 down, rally, 3 down. Now I'm all the way up into this week's moves. So now I'm going to drop this back down and I'm going to go to the hourly chart where I have today. So the hourly chart where we just left off picked up here, 2691. Is that what's that day? That's the 31st. So that other hourly picked up here on the 1st of February. But here we got up to 13,599.75, and that was after, I don't remember whose earnings came out, but somebody's earnings came out, and boy, they just jacked that thing right up there, and it was like, happy days are here again, and we're all jumping up for joy. And I thought, I mean, I have additional numbers above where I thought it should go. So I was thinking, okay, it can get up to 13,640, still be within the realm of reality, and it's a perfect Fibonacci resistance number. Look what it did. 3 waves down. Now, when I got to here, I posted that I would love to call and say that this is the top of that cycle wave 3, and we've begun a cycle wave 4 corrective move, which is going to suggest that we're going to go down, form an A wave, come back up with a B and down with a C, and end up back towards that 6,400 level. So it got down, halfway, right? So it got down to 12,000, still needed another 6,000 points in my view, and just tore butt and rallied and rallied and rallied and rallied and rallied. And what really kicked this thing into gear? Well, we had Google and we had Amazon. Amazon sort of blew the doors off, but not really, because I guess Amazon Web Services didn't do so well. But Google blew the doors off. They blew the doors off their earnings. They were impressive. And so Google starts moving above $2,000. These are historic highs for Google, and they're holding. Well, that can again leaves this as the end of likely the 3rd wave of the 5th wave. This is wave 4 of the 5th wave. And now we're going and we're finishing the 5th wave of wave 5 of cycle wave 3. So you can see this building block. And what we're finishing is, and it'll back out to my monthly, we're finishing this, the rally that started in 2002. In October of 2002, we are finishing that cycle. And it is taking 19 years, but it's going to be a cycle, 5-wave cycle, wave. And actually what we're finishing is cycle wave 3 out of 5. What that portends is that we are going to see a correction likely back to this area, because under Elliott guidelines, fourth wave corrections will normally fall within the territory of the fourth wave of one lesser degree. So this cycle, then I have to go down to primary, and that's what this was. So I'm looking for it to come back down, maybe back all the way down to here, or back down to here, before it would then finish that. And I would think that it's going to take at least a year, if not more. And it's going to involve an A wave down, a B wave up, and a C wave down. C waves are always 5-wave affairs. So you can start to look and see, you're going to get your signs. A waves can be 3 or they can be 5. Depending on how this thing unfolds, we may end up just getting an A wave down to here, even higher, and it turns into what we call a flat. So the A, the B, and the C all end up in the same area. The highs and the lows are basically within that same range. If we get what they call a sharp, then it could be A, B, C. Because of the height, because of the market, because of the fragility of the market up here, I think that we might get a sharp correction and it'll just come off. Again, this is the NASDAQ. So, but I also be looking for basically the same thing, but the account might just be a little bit different, but the correction won't, in the Dow, in the S&P, and in the Russell. So what people ask me next is like, well, what else is going on? So what's going to cause that? And as I often said, I don't know. Right now, you could pick a lot of different reasons. We have a lot of problem areas on the globe and within the United States, which need to be worked out and need to be worked out favorably, but they may cause a bump in the road. We may see some hiccups along the way in a recovery package, in a getting a hold of this pandemic and putting a stop to it, or getting this country and in turn the globe to a more herd immunity level. And the only way we can do that is through vaccine and inoculating everybody. Well, yet to be seen. We're already seeing that we've got some bumps and grinds, just trying to get that started. We have to get people back to work. We need to get our country back to work and manufacturing things here. So how difficult will it be to get the infrastructure plan from the current administration implemented and going, which will put a lot of people back to work and good jobs, because it's going to turn over a lot of Ford, General Motors, and other companies in the Detroit area from producing gas or combustible engines to producing electric. Now, it's a fantastic plan. And if they really can get it, I think it's our way out of a depression, because if we can't and we stick to the old was going to drag us straight down. We will just fall, because Amazon, Apple, I mean, technology can only support us for so far, but they can't support a whole economy. So we can't be deceived. The fact that Amazon is trading over $3,000, Apple basically made new all-time highs a week ago. We have Google up at new all-time highs. There are a lot of companies above $1,000 trading within the NASDAQ on a tech basis. That's supporting a lot, but we got 330 million people here and growing. So I think that we've got a lot of people that we need to put to work who are not very tech. They're not advocates of technology. They may want them because we all have the smartphones, but in terms of supplying jobs, they're not going to get those jobs. So we need to help people get work so that we're uplifting the whole midsection of our economy to bring it right along and in line with everything else. Now, the bumps and grinds and getting all that going, I believe, is what will produce our corrective wave. How severe those bumps and grinds may be, are going to help us determine what kind of a correction it's going to be. Now, I love corrections. A lot of people fear them. It can't go down. It can't go down. It's like, you could just need to be prepared for it. You need to know how to play it. You need to know what gets put together. And that I think you get with experience. If you have experience in the market, you're going to begin to understand the pecking order, as I call it. The pecking order of everything starts with interest rates. Interest rates control just about everything. So no matter what your currency is, but we'll call it the US dollar is falling prey to what the movement is in interest rates. Who wants them? Who doesn't want the dollar? So you got that factor. Then under the interest rates, then you start to get municipals, you get bonds, then you've got things underneath there, and it all just feeds down into one another. And that's what can propel an economy or kill an economy. So you do a little study there, but you put your picture together. And again, remember, this chart that I'm showing you here, it's a monthly chart, and it's a long chart. So one of the beauties of Elliott is that it's applicable on no matter what size chart. I use a 1 minute chart when I'm trading during the day. And I'll show you which charts that I have there. But first I want to go to here because you probably were wondering what that was. What's that little color blurb up there? See how insignificant that is on a monthly chart? But when I put it up on my hourly chart, here it is. And it's today. This is basically today's opening and its ensuing rally. And that rally actually in its strength happened in the last hour. And which is why I love the NASDAQ. And really what we saw happening was massive amounts of new money. This is the first week of February. This is when everybody starts getting their 401k money. They're going to put it in, and boy, it comes in, and here we are. Now, part of what you want to do when you're doing this analysis, and I'm now going to go over to my trade screens, and here I have that same hourly, and now I have a 5 minute, and I have a 2 minute, and on a different system altogether, I have a 1 minute. And I can break that down into tick. So how do I use Elliott Wave during the day? I can draw, well, you can see all of these resistance and support lines are equated and built off of this hourly. And again, I tried to determine, well, was the overnight low, because this is Globex overnight low of Wednesday to Thursday. And I looked and I think about, like, well, you know, it did get up to 13,584.50. The previous high was 99. It was on a blow off type of a high, and it came screaming right down off of that. So I'm like, well, I don't know. But this is best counted as an ABC down. And I had to leave it open because I thought, okay, maybe, just maybe, it'll revert and it'll come out as a 5 waves down, but it just is too squirrely. So I'm leaving it as a 3 waves down, followed by what could end up being 5 waves up. I'm thinking that this is going to be the completing 5 waves to finish that cycle wave 3, setting the stage for cycle wave 4, which we got to then be looking for our signals. The signal that I was taught of a market turn is on an hourly chart. You must be able to count off of the high, and again, this isn't, but off of the high, we need to be able to count 5 waves down. So let me go back over to this chart, which I'm going to be able to show it. Here's the other high, which came out last week at 13,599.75. Boy, did we get close. Could I call it the failure? Yeah, I could. And that's why I left open the possibility. I thought, well, I'll just see what happens. But then it did this. I'm like, well, I think we're going to go up. What's my next level? Let me pull it down here for you. There's a Fibonacci 1.36 at 13,640, we'll call it 41. More common, that is a common area where it could stop in terms of the rally. And that's nothing more than just, if I'm now looking to put out and see where this wave 5 is going to come in. So I need to then look at wave 1, which is probably down here. So if I go to 13, let me get over. Come on, follow me. This is 13,084. Let me just put that in. Let's go. We'll do it the right way. 1384, and I'm going to take off this low, which is 12,727, 727.25. So we have 356, or we're going to call it 357 points. That was wave 1. Now, so if I have to add 357 points to this low, if I'm going to call that the low of wave 4, that's 13,345. I'm going to leave it there. So that takes me to 13,702. That would be the expected, because quite often a common relationship within a 5-wave advance is that wave 5 is equal to wave 1. That would be the first. So that's what I'd be looking for. This is wave 5. I'm looking for it to come up here. Well, look what we got at 1618, 13,732. I'm looking for 13,702. Boom. Coming right between 1.382 and 1.618. And I bet you if I put a 1.5 inside there, it's going to come even closer to 13,702. So we're now beginning to build our story, and we're now beginning to see these Fibonacci relationships, and now we can start to target. Now, could it end there? Absolutely, because in essence, all wave 5 needs to do is go to a new high above wave 3, which is here, but also finish above here. So once it gets above 13,600, bingo, we're there. Have I seen where it's just been a point or two? Yes, I have. But again, think about what I'm finishing. I'm not finishing a small wave. I'm finishing a pretty much bigger wave. So I'm going to look for that blow off to go up and over. So 13,604, 641 definitely could stop it. But do I think is 40 points enough? I don't know, could be. So you begin to develop what you're dealing with and where things could turn. Now, again, if you're a day trader, this would be a major turn. It just sets you up to how you want to start approaching the market the next sessions, because it's going to go down, and it should go down fast, and it should go down hard. If you are a position trader and you're in positions that are still calling, for a bullish move in any of the stocks that are within the NASDAQ, understand one goes, they all go, because they're selling an index. An algorithm comes out and says a basket of stocks in the NASDAQ 100, a basket of stocks in the S&P 500, and a basket of stocks in the Dow 30. Now we have the Russell 2000. 2,000 stocks are going to be sold there. How many of them are in each other? So you get an understanding at that time, and I know I'm presenting a lot of information, I apologize, but it's a lot to try to get out. You start to kind of put together your picture in terms of Apple is in the Dow, it's in the S&P, it's in the NASDAQ, and I believe it's in the Russell. Amazon is in the NASDAQ, and I believe it now in the S&P. Tesla's now in the S&P. So understanding what is in the stocks and how that correlates with the other indexes can be interesting, can be useful, but I leave that up to each individual. So right now, I continue to play intraday. I'm a day trader. So I'm going to go back. Now I'm back onto these charts. Now, what I also add on an intraday basis, and you can see them, are moving averages. I have a 4, an 8, a 20, a 50, a 100, and a 200-day moving average running all the time. I have a little bit more time, so I'm going to go over it real quickly, but please understand that it can be a little bit more complicated than that. But moving averages are going to go, and they move with price. When right now, look at this 2-minute chart. That's the 200, the 100, the 50, the 20, the 8, and the 4. They are lined up and primed to go higher. So is the 5-minute. So is the hourly. Look how beautiful these things are lined up. So when you see this on your hourly chart, and you see it on your 5-minute chart, and you see it on your 2-minute chart from here, that's where you got in. 13,525, 526. You got in. And maybe you would have waited till it broke above that level. Still okay with me. $20 a point. And the NASDAQ will move freely. You can get a 30-minute drop or a 30-minute rally in less than a minute in the morning. As baskets and the algorithms are moving in, doing their opening salvos, their opening orders, their opening buys, their opening sells, and it just flips and flies all over the place. It can be extremely volatile for good reason, and that can make or break an account. I love the volatility, but I can't tell you that there are days that I'm calling this index some pretty severe names. It's usually because I'm getting my butt kicked. But if you're nimble, if you're quick, if you're not married to a direction, if you know when to hold it, when to not hold it, again, with all these moving averages all lined up, oh, it's a beautiful trade. We're not trading right now, so they're not moving anymore. But there were periods like right there, and this is this morning. I mean, I'm on East Coast. I'm on the West Coast, so 11 o'clock in the morning for you Eastern, and 8 o'clock here. All of those indexes, those moving averages, were basically flat. What did we get? It got flat. We went nowhere. We churned up, we churned down, we churned up, we turned down. But and you took this on a 1 minute, and it made you crazy because it was what we call very wicky. You get a topping wick, you get a bottoming wick, and you got, and that's all it would do. But eventually it's going to break. Eventually it will move out of that. Have I seen entire days? Yes, but not more recently. I've seen long periods. This is a pretty long period of sideways trade. And you can see your moving averages were flat. If they're flat, that's because prices aren't going anywhere. They're just sitting there doing nothing. So I like to use my moving averages. In particular, it's like, here we are, we're sitting up here, and now let's even work on the 2-minute. I got a 4 and I got an 8. If it starts to break down below the 8, well, my expectation would be that it's going to reach down to the 20. And then if it doesn't hold the 20, it may begin to drop down to here. Because you're going to start to see things accelerate, because there's a lot of algorithms that are attached to trade when these moving averages are hit. And that's both directions. But you can also see in a rally, you'll notice here, look at this. See, this is a 2-minute chart. See how the rally continues to hold and hug the 4 and then rallies again? So this one rallied up, came back down, basically held the floor, 4, and then kept going. Then this little decline right there held the 4, and then it rallied. Held the 4, then it rallied. Began to break the 4, giving you an idea that maybe we pull back a little bit more. When it did, it only went down to the 8, held the 8. Now it's holding the 8 right up into the bell. So learning to put all those things together are very helpful. And they will help your trading. Moving averages are also applicable on individual stocks. Elliott Way Principle is totally applicable on stocks, on bonds, on precious metals, on commodities, on Forex. Markets ebb and flow. It's the nature of the beasts. I don't care what market it is, it's going to ebb and flow. It's affected by news. And some Forex, they're affected by economic news from a particular country, ours included. Bond prices, it's a function of interest rates. Are we looking for higher or lowest interest rates? What's the economy doing? What's that number going to improve? What's the ISM going to do? What is the CPI index going to do? The PPI index, et cetera, et cetera. When you're a day trader, you want them. You want the numbers because you're just there for 30 seconds. Long-term trade for me during the day, folks, is 2.5 minutes. I'm like crawling down in my chair. When I'm gonna have to sit and I'm waiting. Oh, come on, guys, let's go. Let's do something. And because I'm waiting on a position. I'm waiting with a position or I'm waiting to start a position. So if I'm in a position, normally I'm in and out within a minute. And you can, if you're in a move, be it down or up, that's now going to take an hour. Well, it doesn't just go straight down. Did on the hourly chart, but it goes down, it goes up, it goes down, it goes up, it goes down. And there are times when you're adding to a position, you get out of some. And then as the market maybe rallies back up because you're working a sell, you pick up, you add to your position here. Now you're reducing your position down here. You get back in, you reduce your position, you get back in, you reduce all until you're following and move all the way down. So there are different strategies that one can use. I want to end with that no matter what you choose to use to give you that assistance in where are we going to go, what's the potential for these different types of move. There are many, many different systems out there. Most of them have commendable qualities. They're usable. But I think even as Sean was mentioning in the previous webinar, you have to have a learning curve and you really got to go in and you got to learn it. I tend to not want to necessarily believe one person. I want to learn about it, learn everything I can about it, and then apply it, and then begin to see how does it react in this market that I'm trading. And then develop your strategy around it. Moving averages I have found to be a very, very valuable tool, particularly because there are so many algorithms firing off orders and scouring the markets across the board. We have algorithms scouring for option trades. The option trades happen, they're now hedging. They're taking advantage of volatility, premium, and making fortunes. And there are algorithms that come in and trade futures. And they set those up, and the algorithm's function might be that if the market goes above the 50-day moving average, it sends out a flurry of buy orders. It's going to get in. And in the converse is that if it breaks it, it's going to get out. I know I presented a lot of information, and I thank you all for hanging out with me. And if you get a chance to come and see, I like doing the webinars, but I try to do them during market hours. And then you're going to be on my other screens. because I like doing them live. I like taking trades. And so people can actually see, other traders can see how this works real time. I really like doing that. And so I know I booked with David for a couple of additional ones coming during the year. I invite you, please come join me, because I love to show how all of this works in real time. It's easy to explain, just like this, but in real time, it makes a big difference. I'm going to open it up right now, should anybody have a question, and they, please go ahead and put it in the Q&A box, and I'll try to answer that for you. If you want to get a hold of me or see some of my work, I now joined forces with a wonderful web person, and she has been setting up our new website, and it is www.tradershelpingtraders.com. And right now you'll find me there. And I started with Eye of the Storm, which has been a domain that I've owned forever. So Eye of the Storm, and also Logical Signals. You can still reach me by email at michael@logicalsignals.com or michael@mjf1partners.com. And I like getting correspondence. I like talking with people. I like answering questions, and I don't have any problems. So I would encourage everybody to please go ahead and send me an email if you have a question. Within the website, you're going to find some analysis that I write, and also you're going to find, you'll find also Rich Friesen from Mind Muscles Academy has a couple of things there. Another analyst that went through the Mind Muscles Academy that I have a high respect for. He does some coaching and some analysis. And also we have some additional thing from a gentleman who runs supportandresistance.com. And he's on there with a little bit of information. So Traders Helping Traders, hopefully, is going to meld into a site where people can come and find help that they want or contribute. So it's kind of like going to be a two-way. If you've got an indicator that you really love and you think you want to put it out there and see what if somebody else wants to try it, it's there. So again, send me an email, tell me what you think you'd like to do, and we can go from there. And in the meantime, I thank you all very, very much for sticking around this afternoon. I know it's only going on 3 o'clock here in the West Coast, but it's dinner time in the East. And you guys have had some pretty nasty snow. And I hope to see you again. And thank you, David.